Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings to find the juicy bits in this Cavco Industries Inc. 10Q filing is no different. Get ready for a deep dive into how their housing and financial services businesses are really doing and some surprising moves they made. And hey, if you love getting these kinds of breakdowns that actually mean something, make sure you are subscribed. We also have a super active Discord community, link below in the description. Alright, so Cavco Industries Inc., a player in the factory-built housing and financial services world, just dropped their quarterly report for the period ending the 27th of September 2025. And we are here to decode it for you. Let's jump right into the balance sheet. As of the 27th of September 2025, the company has total assets of about $1.45 billion. That is up from around $1.41 billion at the end of March. Their cash and cash equivalents also saw a nice bump, sitting at over $374 million compared to about $356 million a few months prior. This shows they're holding on to a good chunk of cash, which is always a good sign. Now, inventories are up slightly to over $258 million. This means they've got more homes and materials sitting around waiting to be sold or used. It's not necessarily bad, could mean they're gearing up for strong sales ahead, or maybe just have a lot of product in the pipeline. On the flip side, their accounts payable are around $44 million. This is a pretty standard number, indicating they're managing their short-term debts well. Moving over to the income statements, here is where things get interesting. For the 3 months ending the 27th of September 2025, net revenue was $556.5 million. That is a solid increase from $507.4 million in the same period last year. For the first 6 months of the year, revenue is up to $1.11 billion from $985 million. This growth is definitely good news. Their gross profit, which is what is left after the cost of producing their homes and services, is also up across the board. For the quarter, it hit $134.4 million, up from $116.1 million last year. For the 6 months, it is $263.9 million, up from $219.5 million. This implies they are not only selling more, but also managing their production costs effectively, or passing on increased costs to customers. Selling general and administrative expenses, the costs of running the business beyond making the product, also saw an increase from $67 million to $72.2 million for the quarter. This is generally expected with growing revenue, but it is something to keep an eye on to ensure it doesn't outpace revenue growth. The factory-built housing segment is the star here. Net revenue for this segment jumped 10% in the quarter to $535 million. For the 6-month period, it is up over 13% to just over $1 billion. This is driven by higher home sales volume and an increase in the revenue per HOME sold. Now, that revenue per HOME metric is always a bit fluid, but seeing it increase for both wholesale and retail sales is a positive sign. It implies they are either selling more expensive homes or successfully increasing prices despite material costs. The financial services segment is also showing growth, though less dramatic. Revenue in this segment nudged up 1.4% for the quarter to $21.4 million and is up 4.7% for the 6-month period to $42.5 million. This segment is seeing growth mainly from higher insurance premiums. But here is a real eye-opener. The gross profit margin for financial services jumped from 21.8% last year to a whopping 55.6% in the quarter. This is a massive improvement. For the 6-month period, it is up from 11.1% to 48.3%. They attribute this to higher insurance premiums and lower claim losses. With improved underwriting and fewer severe weather events compared to last year, this segment is now a significant profit driver. Overall, the consolidated gross profit margin improved to 24.2% from 22.9%. This is a testament to their operational efficiency. Interestingly, while SG&A expenses as a percentage of net revenue decreased slightly, suggesting good cost control relative to sales growth. Now let's look at some other income and expense items. Interest income has seen a slight dip to $5 million for the quarter and $10.1 million for the 6 months. This is likely due to lower interest rates on their cash holdings. Interest expense remained minimal. Income tax expense did increase notably to $14.8 million for the quarter and $28.5 million for the 6 months. This is directly tied to their higher profits. The effective tax rate is hovering around 22%, which is pretty standard. On the cash flow statement, net cash provided by operating activities was $133.9 million for the 6 months ending the 27th of September, a good increase from $102 million last year. This is fueled by higher net income and strong customer payments. Investing activities show they spent $18.8 million on property, plant, and equipment. This indicates continued investment in their infrastructure and production capabilities. Financing activities show a significant outflow of $89.2 million. A big chunk of this, or about $86 million, was spent on common stock repurchases. This means the company is buying back its own shares, which can make existing shares more valuable and signal confidence from management. All this financial performance translates into earnings per S-share. For the quarter, diluted earnings per S-share was 6.55, up from 5.28 last year. For the 6-month period, it's 12.96, up from 9.38. This is a strong indicator of profitability growth. Diving a bit deeper into the financial services footnotes, we see consumer loans receivable. The total is around 52.8 million. The weighting average interest rate is about 7.8%. The delinquency status shows about $1.2 million in loans are 91 days or more past due. This is a small percentage of their total consumer loan portfolio. Interestingly, a substantial portion of their consumer loan portfolio, over $38 million, has a FICO score of 680 or greater. This suggests a strong focus on prime borrowers within their loan offerings. Geographically, Texas continues to be a major concentration for their consumer loans, making up about 47% of the portfolio. Florida follows with about 15%. This concentration can be a risk if economic conditions in those states take a hit. Commercial loans receivable are around 107.4 million. The weighted average interest rate here is about 7.7%. No commercial loans were reported as non-performing, which is also a positive sign. For commercial loans, California, New York, and Arizona each represent about 14% of the outstanding balance. They also have 11% of their net commercial loans receivable from one independent third party and its affiliates. This concentrated relationship could pose a risk if that party experiences financial difficulties. Now, for a big strategic announcement on the 30th of September, just after the reporting period ended, they completed the acquisition of American Homestar Corporation. This acquisition includes 2 manufacturing facilities, 19 retail locations, and financial service operations. They paid $190 million for this. This move is clearly aimed at strengthening their position, especially in the South Central US, and expanding their retail footprint. They also mentioned this was funded with cash on hand, which is great given their healthy cash reserves. Looking at the overall picture for Cavco Industries Inc., they are absolutely crushing it in their core factory-built housing business. Revenue is up, profits are up, and they are investing in their future with new acquisitions. The financial services side, especially insurance, has seen a dramatic improvement in profitability, which is a huge positive surprise and is now contributing significantly to the bottom line. Their acquisition of American Homestar is a bold move that could really pay off in terms of market share and expanded reach. Now, there are a couple of things to keep an eye on. Concentrating so much of their consumer loan portfolio in Texas and Florida could be a double-edged sword. If those economies falter, it could impact their loan performance. Also, that significant exposure to a single commercial loan customer warrants attention, but overall, the company's direction seems strong. They are growing, innovating, and making strategic moves to expand. Alright, that is our breakdown of Cavco Industries Inc. Its latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, and we will see you next time.